welcome to the June edition of the Market Update. Each month I put together this little video in an effort to try and educate different investing Americans really on what I'm seeing in the investment markets. My name is David Hobbs. I'm one of the founding partners at a firm in Indianapolis called Cedar Wealth Partners. I'm also a certified financial planner as well. In this month, we're going to be talking through what's happening in the current market environment, as well as looking at history as a guide. So to really kick it off, really what I want to touch on are just some comments that recently came out from Jamie Dimon, the CEO of JP Morgan Chase. And he certainly did make some waves as he recently cited a concern for a recession. Now, hear me loud and clear. Only time's going to tell if he's going to be right or wrong. However, I certainly don't believe in trying to time the market. Personally, I've learned that from Warren Buffett, Bernanke, and Peter Lynch. However, the past few weeks certainly have been noisy. And one of the largest data points is on May 20th, 2022. The S&P 500 dropped about 20% off its peak set earlier in the year. And since that low, the market has rebounded about 5%. But when we look at history here, there are only a few other times where we've had a similar market decline that has occurred without a bear market. And as you can see on your slide here are really just some of those instances that you're seeing. And it really does surprise a lot of people that the average market return 12 months later is 22.3%. So, of course, who knows what the market's going to do from here? However, asking the question, what is the market going to do, and are we going to go into a recession? These are really some of the most common questions I continue to receive over the last couple months. And so, from here, really, what I want to touch on are going to be different market truths, market beliefs, and looking at some historical data, as well as some different data inputs that I'm currently looking and watching at. When looking at just different market truths, there are 5 here on this screen that I really do want people to embrace. The first is that the stock market cannot be consistently known or timed. The second, just like the first, is that the economy, as you define it, cannot be consistently known or timed. The third item is that over the past 100 years, the market has returned 10.45% with dividends reinvested. This does surprise a lot of people. And it would be difficult for someone to achieve this return if they did not simply stay invested over the entire 100 years. The fourth data point is that the average intra-year decline is about 14%. And what you're going to see here on this chart is one of the data sources for this type of data, for this data point, and that the average intra-market decline is about 14%, and the market drops 15% or more about every 3 years on average. Now, the fifth and final market truth that I like people to be able to embrace is that investing in equities has historically been volatile, and my guess is that it's always going to be. However, when you consider equities, and when I say equities, I'm using the S&P 500 as a proxy. Equities, real estate, short-term bonds, corporate bonds, over the long term, equities continue to be the historical winner. And if you really want to crystallize this point, this final link here that I have takes you to NYU. It's a really great article to be able to help crystallize this point for you. Now, with the above stated regarding these market truths, I want to go into different market beliefs. And there's 2 such market beliefs. One is that because the future cannot be known, what I encourage everyone is that we must embrace the belief that the world isn't going to end during our lifetimes. And if it does, our money really isn't going to matter. And then the second is that the world has continued to advance since well before Jesus walked the earth. And so, assuming that the world is not going to end, I believe it's rational for us to believe that the world's going to continue to advance over this period of time. So when thinking about market truths along with market beliefs, I really do want to emphasize in investing in long-term mainstream equities. And as part of this, we really must embrace the implied volatility and that equity positions have seen historical consistent outcomes. Now, hear me when I say this, and let me pause. When I say consistent outcomes, I'm referring to 5, 10-year plus outcomes. Additionally, I do have a personal desire to be able to stay away from different trendy trades. And there's 2 different trendy trades that have really caught my attention. One is looking at gold as simply hedge against inflation. And that over the last 3 months, gold is down about 5% while CPI is while the CPI is up just under 2%. I'm going to drag something onto the screen just to be able to see this. This guy here. Perfect. And this is taken from our investment software program called Quanti.com. But this is something that is surprising a lot of people, looking at CPI continue to tick up and gold, unfortunately, ticking down. Now, the other item that I do want to stay away from is crypto and cryptocurrency. And really, to be candid, I've never really understood the cryptocurrency space. Now, if you want to hear why, I will tell you it's a long list. It's probably best just to call me on this. But regardless, cryptocurrencies, what I feel, are really falling from the sky. and what's more, so-called stable coins, right? Stable coins, were designed for safety. However, they're being found to be just as risky. And there's one specifically that was trading at just 23 cents on the dollar. And if you want to look at that, this article is down here at the bottom. And the question of around why, well, why were these stable coins trading at such a heavy discount? Well, because the coin itself wasn't actually backed by the dollar. The stable coin was actually backed by another crypto coin. Now, moving on from market beliefs, market truths, some different trendy trades, I do want to look at a couple pieces of historical data. In 2018, a lot of people don't remember why the market dropped close to 20% from October to December in 2018. Now, the causes for this 20% drop were linked to a potential monetary change, as well as a potential trade conflict between the U.S. and China. And since that low at the end of December to the end of May 2022, the S&P 500 is up close to 81%, which of course includes the COVID recession, as well as our current market sell-off. And then between 74 and 81, this was a long season of historically high inflation. The S&P 500 had meager returns during this period of time. However, when you see inflation starting to slow in 1982, the S&P 500 really does begin to take off with some stellar returns. And back in 1982, the S&P was valued at just $117. As of last month, it was valued at over $4,000. And so when we think about today, hear me loud and clear. We have no way of knowing if the market's going to continue to go up or down, or inflation is set to ease, or really what the future is going to hold. But an encouragement is that the market, what I see, really has been here before, wherever that is. And this is the number one risk. I see the real risk in today's market is being out the next potential advance, not so much avoiding the next potential 20% decline, right? So let me say that again. I personally see the real risk with investing today, not so much preventing the next 20% decline, it's being out the next 100% advance. So with all this stated, this is precisely why we need to focus on long-term financial planning, starting first with identifying what you're seeking to accomplish, and then aligning your wealth around those priorities and utilizing historically efficient investments like equities to help fund your long-term goals. Now, if you're a client with me and you aren't fully confident in your current financial plan or investment strategy, I would heavily encourage you to contact me immediately. If you're not yet a client and you want to look at working towards developing a plan you can have confidence and conviction in, I'd encourage you to do yourself a favor and schedule an introductory call with me. Now, every month I do get asked from different clients and prospects around what type of additional data or data sources am I looking at. And this month I have 4. Now, please hear me when I say this and when I go through this different data set. I am not trying to predict anything whatsoever. This is simply some of the data that I'm looking at, and you can draw your own conclusions from this. The first data point, and this one is probably going to change by the time this newsletter comes out, is the inflation reading. So there's a new inflation reading that's set to come out this coming Friday. So what would that be? June 10th. So the next inflation reading is set to come out. So this data is going to very well change, as it's always going to change. But what I'm pulling from this current data piece of data information from BLS is this sharp decline here, as you can see. And then when you look at the month over month CPI changes, right, inflation changes, you can see this 0.6, 0.7, 0.9, right, it cools off a little bit, 0.9, 0.7, it ramps up 1.2, it's back down to 0.3. We'll see how this shapes out for me. There's going to be a lot of eyes looking here as far as what the inflation market's going to do. The next data point that I want to look at is going to be M2 versus federal budget deficit. So M2, and I've spoken about this a lot over the past several months, is really the broad definition of overall money supply. So how much money is in supply in this country. And so when people think, okay, well, how was this deficit spending financed from the federal government? To me, I can draw some conclusions around how that was done simply by looking at the blue line of M2, money supply, and the red line looking at the deficit. A third data point that I want to look at are PE ratios. Get myself out of the way again. Looking at PE ratios over the past 25 years, you can see this 25-year trend line where the average is 16.85 times forward earnings. At the end of May, you can see we're at 17.3. Very, very, very sharp reversal. Okay. You can see this. This is the COVID recession, right? Very sharp reversal here. So when you're thinking about potentially buying at fair market value, again, this is not a timing tool. This is simply a valuation metric. Okay. And then the fourth and final data point that I want to point out has to do with S&P 500 profit margins. You'll see the difference between the operating profit margin and the reported profit margin. And yes, there is a very salient difference between those two. However, they do follow. What I want to really identify here is when you go from this point, somewhere over here, to this point, somewhere over here. It's easy to be able to pull out over the past roughly 20 years, 25 years or so, an upward sloping line. Okay. And so when we look at increased profit margin, we're looking at reduction in a price earnings ratio. We're looking at a reduction in the deficit. We're looking at reduction in M2, as well as potential reduction in inflation. These are just some different data points I'm looking at. Okay. So in closing, of course, we cannot ever know or control what the market does from here, and we cannot predict when the next market downturn will occur. However, what we can control is our behavior to these outside events and continue to stick with our long-term investment strategy. As always, I appreciate you tuning in. Thank you for your trust. Should you have any questions, please feel free to reach out. Thank you.